So this idea of, these cycles sort of shortening nowadays, would you guys concur with that? Or is that how, are you viewing some of these decisions differently than you might have prior to what we, gone through the last 2 years?
Sure, I guess I'll go for yeah, I think that there's a very large behavioral component to the markets. And I think with the ubiquity of information in this cycle versus some of the prior cycles, just, literally half of us in the room now are looking at our BlackBerry and, information just sort of flows that much faster. I definitely think that this distress cycle was much faster than the early 90s distress cycle. If you look at the credit markets today, there's literally nothing to do. I mean, you have there's few large sort of liquid distressed opportunities. There's every distressed fund likely has a large position in CIT, and then they have a couple large positions in a couple other things, and that's pretty much it, because the information's so ubiquitous. Everybody, the spigot turned on in mid last year, money came back in, and now sort of the big question will be how the capital markets react when rates start to move, or when we start to see some resetting, if it's a sovereign event. So, that's sort of the big question, but it sort of feels like the distress cycle has ended. Mm-hmm. This distress cycle ended but people are sort of sitting on their hands with a pause. If we have sort of a low growth muddle through, this distress cycle will, the big returns have already been made. If we have another snap back down, it could get tough again, but that's likely going to be due to a rising rate environment because the inflation situation got out of control, or it's a deflationary situation. But odds are likely it's sort of a tough muddle through, in which case the opportunities will be a little bit less than I think a lot of people expected going into this, going into this period.
Interesting. Charlie?
Yeah, just to comment on that, I do think the markets themselves have gotten faster and more efficient, but the institutional flow process actually hasn't changed that much. And unfortunately, money still chases performance on that same calendar of endowment and finance committee meetings. And the endowment committee and the finance committee still meets quarterly and makes the decision based on what happened a quarter ago, and then puts an order in to withdraw or add to a certain asset class late. And so you still get massive flows chasing past performance, which has the effect of accentuating the effects in those markets. So I think the best example of this is the high yield market, in which when there is a great opportunity, money flows in, and then way too much money flows in, and the high yield funds have to buy the public high yield bonds, and they get overpriced, and we all see it, but they have nowhere else to go. And so high yield bonds get overpriced, and companies start issuing zero coupon bonds, and the cycle just will repeat itself. So while the markets are pretty efficient, the funds flows are not. They're late, and they chase performance, and they open up opportunities.
And can I just add to that point? I think it's a really good point. About a week ago, I saw an article literally on the same day, and I forget the publication, but there were articles that CalPERS, due to losses in private equity and real assets and sort of the liquidity constraints that they faced, as a result of 2008 and 9, were revisiting how they allocate their capital, and were going to reduce their private equity, real asset, and other illiquid portfolios. That same day, there was an article, an interview with David Swenson, who runs the Yale Endowment, who's arguably one of the finest investors in the institutional endowment landscape. And Yale is actually, because they lost so much money in real assets and private equity and illiquid investments, are increasing their exposure. And I thought it was just very interesting to see how the same data point, the same experience, and how different institutions might react to it. And unfortunately, or fortunately, or however you look at it, CalPERS is sort of a significantly larger institution, and is probably more representative of kind of how the institutional investor community might react versus how they did. But I thought that was an interesting point just to.
Yeah, and just to pile on, I think CalPERS is much more normal than Yale in this regard. And I think you see it always, the best vintages in private equity are always after the worst vintages, because there's not much money that flows into private equity, and So there's not a lot of competition for deals, and so the returns are the best. And yet, of course, what is everybody doing right now? They're reducing their allocations to private.
The only thing, I'm sorry to pile
Yeah.
on, I just have one more comment on that. The one thing that Charles mentioned in terms of the markets being more efficient. The only thing I'd probably add to that is that the information flow out there is more efficient in terms of the amount of data. How it's used, in my view, has become even more wildly inefficient in terms of the investors, in terms of wild swings back and forth. And so I am impressed or amazed or what have you that it seems like there's a direct increase in correlation between the amount of information that's put out and the lack of efficiency with which investors use that to make investment decisions. It's just sped up in my view.
Interesting. So I wonder, you know, Charlie, maybe from your perspective, given what you described, Ariel, having gone through, what now are your challenges when you talk to clients, and how do you, how do you address some of those swings that you
Right.
saw?
I think the challenge is to manage expectations properly. I mean, the motto of our firm is slow and steady wins the race, and we emphasize long-term investing, and we talk all the time about how hard it is to predict short-term markets. And the challenge is to really, really grab people by the lapels and say, I can't promise you what's going to happen over the next quarter or year, but I do believe that what we do works over the long term. And people will nod at you and say, I get it, I'm a long-term investor. And then when markets become irrational, you know, they forget all the conversations we had up front. So that becomes the discipline that our firm has to take is now, because we have had a great year and because the long-term numbers now look good, we are getting a lot of inflows, and we have to be very disciplined about who we take on as new clients, because obviously it's so easy to just say yes to everybody, and that's very hard to do. It's very hard to say no to a new client, but that's what we really do have to do.
Any comments?
I would just add, and just add to what Charles said. When you're prospecting, talking to new potential investors, and then when they're investors, be extremely clear about how you invest and what they should expect, not in terms of return. Of course, everybody cares about that, and that's the ultimate measure, but how you generate that return. And you need to be very specific with regard to how you go about investing money, because there'll be times when you'll look like a genius and you're really not, right? It's just things are working, and the other times you look like an idiot, but you're really not, right? And what you want to be able to do when you show up to those quarterly meetings and you have, you know, investors in your office is to show them that you've been consistent with how you've managed their money. Not, you know, defending your returns with regard to where the market is. You need to be consistent with showing them how you've managed your money, and that it's the same, you're the same manager in the same style, doing the same stuff they hired a year ago, 2 years ago, 3 years ago. If, in my view, if you start shifting and saying, look, we find that this is going to work, or we're doing this, or are less than clear, then they're just going to fall back on performance. And when you start to stink, they'll fire you.
I wonder, Jim, if you know, as you guys think about maintaining relationships at clients, has what you've gone through changed the way you're approaching your client base? I mean, are you still focused on the same types of clients now, or is it?
Well, I think we have a very unique situation, which is we have, you know, I've always viewed it that I run a financial institution in partnership with my clients, and so we have, you know, sort of slightly longer duration capital than, you know, sort of, you know, a lot of the industry, and I think we also have a very, you know, very savvy client base. So I actually probably learn more from my clients than they do from me, and so it's really it's a dialogue. So maybe I'm not a great person to answer the question, but you know, and also I think, you know, our sort of core investment philosophy, just to kind of, you know, speak to Barry's point, is in what gives us a little bit more flexibility is that, you know, my view is that investment styles are cyclical, just like industries. And, you know, which is, to Barry's exact point, which is sometimes the manager's a genius and market went well, and sometimes the manager's a genius and the market, you know, the manager's still a genius, but it was just that style got out of favor. And so what I always say to my clients to sort of condition them for, you know, a little bit more flexibility is I say, you know, there's good news and there's bad news. The bad news is you never know exactly where I might be looking to make money or what I might be doing. You know, we'll certainly tell you exactly what we're doing, how we're doing it, and what areas we're looking, and you'll know exactly what we own. But, you know, we may be somewhere, you know, tomorrow that we weren't today. The good news is, you know, you don't have to worry about style drift. So, so that's how we manage expectations.